investor at the growth stage, we do focus largely on Series B and afterwards companies, but of course still pay attention to what's happening at the earlier stage in little bits. And essentially what we're observing is that these massive mega rounds are happening for more de-risked companies in a way. So like we have the OpenAIs, the Anthropics, Databricks, and several other really large fundraising journeys that have happened in last year, including a few of those companies raising, I think probably all of them actually, multiple times in one calendar year. And what that ultimately has done, and not to put any blame on these companies, of course, is just to make the market think that there is tons of capital waiting on the sidelines, which is in part true, to invest in the entire AI market. So what we ultimately have are a number of companies that are maybe at the earlier stage, the more early growth stage, who expect to get similar multiples to raise similar amounts of capital, maybe not in the billions, but closer to the $100+ million range, which aren't completely in line with expectations of investors who might be willing to put in larger checks at higher valuations for these companies that are more de-risked in terms of the stage that those companies are at today.
Definitely. That's a fantastic point. And hey, Yaz, we're just going over what everyone's seeing in terms of the funding market right now. So very broad base, and Becca called out some really good points around. We're seeing these headlines, we're seeing these $1 billion outcomes, but what is actually kind of happening under the hood?
Yeah, it's a great question. And what we're seeing is honestly a story of the haves and the have-nots. Some companies are going out and they're able to raise, and many of which are gloating about the fact that they didn't even have to pull together a pitch deck, and they're raising easier than ever with larger round amounts than we've ever seen at higher prices than we've ever seen. And frankly, those companies tend to have some super compelling AI story around them, while others, which are great businesses with strong fundamentals, are going to market and they're getting pretty negative perception from the investor community that they're pitching to. And so we are seeing this interesting dichotomy of the market of those that are going through fundraising processes easier than ever and others going through processes that are more difficult than ever. And we can dive into some of the reasons why we think so.
Yeah, I'm curious what those reasons are, because we certainly are seeing a lot of headlines around billion-dollar AI rounds and record valuations. And, we can see a lot of Carter data that's been published around just venture stages and how much investment dollars are going towards AI. So from both of your viewpoints, what's really happening under the hood? Why are we driving these kind of headlines?
Yeah, I think this is a really interesting slide. And just to point out, I think it's from 2024 data, which is actually helpful to look at because we can talk through essentially how I would imagine this data has changed for 2025 year to date. So as I look at this chart, and it kind of harks back to a conversation as I had last week as well, is I think what we would see if we were to look at this for 2025 is a really big increase in the percentage of funding going to AI companies at the seed and maybe Series A stage. And then also a huge shift in the Series E+. So again, going back to like the massive amounts of dollars when companies like Databricks, OpenAI, Anthropic, and others. And kind of in the middle, I would imagine for funding to be relatively down, but still shifting predominantly to AI companies. So a few reasons focusing at that early to mid stage a little bit more. Investors today are more than ever, we don't have the crystal ball, right? It's always difficult. In fact, I've had a lot of conversations recently with professors of AI, PhDs in AI, thinking they must have the answers, right? They're going to know what things are going to look like in 5 years to help me to de-risk my investments. And the very blunt answer I get is, we don't know what's going to happen. And so if you're thinking about investing at an earlier stage, whether that's seed, Series A, B, maybe up to Series C, there's a lot of concern that if you start a company or are building a company that isn't AI native, what is the risk that a company is going to come along in the next few years that is AI native, that can deliver higher value to the customers and also do so more efficiently? And so there aren't major incentives to be investing in non-AI companies at those stages today, just given the risk profile is still investing at those stages. When there's a lot of innovation that we're expecting to come out still in the next few years and very little clarity on how those technology stacks are going to be looking. Yaz, I'll let you cover the kind of point on the Series A and Series Bs, which I think was really, really insightful.
Yeah, I think I'll even like underscore one of the points that you made, Becca, because I couldn't agree more. Many of our early stage companies are going out to raise growth capital, and those that existed in the pre-AI native era, the feedback we're just getting from the growth investors is like, we're afraid you'll get leapfrogged by someone that's AI native and growing really fast and all the rest of it. And, you know, at the earlier stages at seed or Series A, often you don't have the, I call it the burden of data. And so people have like this imagination of where this new technology can go, and they see some of the headlines of companies that have gone 0 to 100 or 0 to 500 in record time. And so when you underwrite to, oh, we have no existing data, but like the story is very compelling, the demo like kind of blew my hair back. I really think that this company has the best team. They're the 21-year-old dropout that like interned at whatever hot company over the summer. They're going to defy physics and they're going to grow into becoming the next Cursor, the next Core, what have you. And so without data, you often have people imagining more what could become. And so what people start underwriting towards more is like, are these folks really at the cutting edge of the technology? And are they really going to be focused on where we think the market is going as opposed to where has it been? And so at the earlier stages, you're seeing a lot of that. When you get to A and B, that's when you start to see revenue growth that is actually quite fast. And now I think like in the earlier days of this AI native era, we found everyone was growing really fast and everyone was getting funded. Now I think there's actually an increased level of scrutiny, which is like, how strong is the growth actually? And double clicking into what's driving some of that growth. And so now I think we're finally starting to head into this phase for Bs and beyond, where people are starting to take a microscope to the growth and realizing that $1 of revenue isn't created equally across all vendors.
Such an important point. And Patrick has a great question here, just to take a little bit of a step back for everyone listening. How would you both define what an AI company is?
That's a really great question. I think it involves a lot of nuance. Essentially, any company that involves AI could be considered an AI company. I don't imagine that Carta. I would be actually really curious to see how they're cutting that data, but I'd imagine if you have an AI feature, you could be an AI company, and if you're an AI native company, you could be an AI company. And I guess we don't say we only invest in AI companies. So it's not really like a important nuance to understand for ourselves. But I think what it kind of gets to is, as investors, what we're trying to decipher is how much value is coming from the AI that is being built into the platforms that might have been existing pre-AI, and also how much of the narrative is actually just a story about the possibility with AI, or how much is it technologically feasible. So I'll give you an example without naming names. There's a company I've spent time with over several years who we are evaluating, and they have a big agentic story. As most companies do, it's the year of agent, the decade of agents, whatever people want to call it. It's important to have some sort of agentic capability that is on your roadmap, right? But digging in further, it's the big questions that my team has had to kind of drive at how probable is it that there is a true agentic capability here versus the possibility kind of goes back to the idea of, is it really just an agentic story or an AI story versus an actual possibility? So hopefully that drives a little bit more clarity in how we think about it, although I wouldn't say we have like a strict definition.
Yeah. On our end, the way I think about it is actually very simple, which is, are you an AI model company? Are you selling to an AI model company to make their models more effective? Or are you benefiting from the frontier of the AI model companies getting better? And that's typically either in the form of an application or a service that's accelerated by AI. And so when I think of AI company, and I agree with you, Becca, I don't like the Carta data. I don't know how they define it. It's probably pretty loose in that AI shows up somewhere in their marketing materials, which is why I think in 2025, the orange bar will subsume the black bar. But like the way our lens is across those buckets that I just described. And the way you assess each of those businesses is very different, right? Like the dynamics, the growth profile, the margin profile, I saw a comment in the chat around we need to invest in human companies. Actually, there's quite a bit of those now. They're AI-enabled services companies where actually the end customer doesn't see the AI. The end customer doesn't care about the AI. They care about the outcome, and that's often delivered through humans using AI within their internal platform. And so we're seeing examples of those. I was just meeting with a founder earlier today that's building one of those businesses. So we are seeing a really tight coupling of human and AI in a certain segment of this market. And yeah, those businesses tend to have different mechanics than some of the others that we evaluate.
Mm-hmm. And let's say for companies that aren't necessarily AI native, what are their options now?
I think with any company, it really just comes back to understanding the value that you have the right to deliver to your customers. And that should be something that any company, whether it's in this AI era or previously, is constantly reevaluating and keeping a close pulse on, especially as they think about their product roadmap and expansion. So I think through that lens, the question becomes like, how do you think about an AI native company essentially coming into the market and being able to potentially deliver more value at a lower cost to your customers? So kind of taking over the market that you've built for yourself today, and just continuing to think about if there's like infusions of AI that you can put in to stave off that new competitor would be important. But it is a really challenging market to be thinking about your options if you were founded in 2018 and previously have gone through several cycles of difficulty over the last few years too.
Yeah. My take is that like generative AI as it exists today, as delivered through some of these closed model endpoints and even open source models, has been around long enough where the kind of story's been written for a lot of companies that have already been founded before that, where it's you no longer can get away with just adding AI on your marketing collateral or on your pitch deck and being able to sell a story. The story has to really drive some business value today. And so there's a question of, can you be non-AI native or not even use AI because you don't care and still grow at the same benchmarks as some of the AI native companies? Because like the data is still early, but at least when benchmarking within our portfolio, we're seeing a lot of those companies growing meaningfully faster than others. But if you fall within the bucket of companies that isn't using that and you're still growing incredibly fast, you can continue going down the venture path. You will continue to raise growth capital. I think the question is whether or not you can effectively deploy it in your business to help accelerate the way you're operating. If you are in a business that's, doubling year on year with good fundamentals and what have you, I just won't sugarcoat it. Like, it's hard. It's really hard to raise additional capital. And so controlling your own destiny becomes really important, which means either get to cash flow break even and no longer depend on venture capital dollars, raise lines of credit from venture debt financing options, or it's do what a very rare select few number of businesses have done and figure out a way to sell into the AI economy. Handshake is a good example of one that's built. They're a recruiting platform for universities and students. They went 0 to 100 million in run rate in 9 months, selling training data to all the big model labs. And they reinvented themselves as a business, and they're raising growth capital off the backs of that. So there are stories like that, but I would say it's few and far between.
Mm-hmm. Yeah, that's a great example, though. It almost feels like there's a bit of a bifurcation where we've got AI native companies and then more of your traditional SaaS models where the growth looks entirely different, but as long as you are still within that track progressive growth, you'll have no problem raising. It's really when you're struggling to hit those specific rungs where it comes into play, and those do look very different between AI native and non-AI native. And curious about the diligence process and what has really changed in this new environment. I know for us, we've made quite a few adjustments at GTM Fund based on the new environment. We're digging into revenue overall a little bit deeper from ERR, so experimental run rate revenue, and ARR. That's one factor that's really changed. And what I mean by this is there's a lot of pilot revenue that's being extrapolated out to annual recurring revenue. But oftentimes, AI native companies are growing at such a fast rate that they haven't necessarily hit that renewal cycle yet. So that's one area that we're digging into personally. And I was listening to a podcast the other day. It was from Intercom's co-founder, and he had a really, really good, simple framework for how he's thinking about assessing AI native companies through a diligence process. And it's kind of the four horsemen of AI. And so he looks for four things, very simply: revenue backed by usage, usage tied to real business impact, deep differentiated AI, and positive unit margins. And those are the four things that he looks for, and that's it. I really love the simplicity of that framework. But I'm curious what's really changed in your diligence processes and what you're seeing.
Yeah, so I'll let you take that one first.
Yeah, I'll go first, which is, so, and as context, we're an early stage fund, so we invest in C through Series B. So oftentimes you actually don't have much data at all to back off of, right? At the Series A and the B, you start to get more, but to your point, Sophie, if you're growing so fast, if you've gone 0 to 5 in 9 months and you're signing year-long contracts, you actually see no retention charts because there hasn't been a renewal event. So in the absence of that, what do you look for? And I think it was the first point in the Intercom co-founders piece that you mentioned is usage. It's, are people using it, and are they using it more? And so while you might not be able to draw insight from revenue retention charts, you can in terms of usage retention. And oftentimes usage retention is a leading indicator of like the unit economics of a business and their customer retention and so forth. And so it's really, depending on the business, it's looking at usage patterns, it's speaking with customers, understanding how impactful this is, understanding the health of the pipeline, and then getting a good sense for where you think things will go over time. There's other dynamics to dig into. To the point around unit economics, we don't scrutinize it as much as an early stage investor, just because there's still so much variability in those types of metrics. Gross margin will improve with time. Sales efficiency will improve with time. So we care more about the pace at which you're growing, the quality of that revenue base, and whether or not you're able to deliver it in a scalable way. And can we paint a picture for how you can do that over time?
Yeah, thanks for sharing the Intercom CEO's framings. I think that is super, super helpful. At Archman Capital, we base our investments on a first principles based investing process. And so really seeing metrics more as like a confirmation of a business's strength versus the reason to invest. And so at the top, there hasn't been a massive change to how we do invest, although I would say that with what's going on in the AI market, it just invites a lot more skepticism. So totally agree with you, Sophie, that we have to be more careful to understand how ARR numbers are actually being calculated, whether that's experimental revenue or whatnot. Just talking with some enterprise AI leaders, we can see very clearly that a number of them, run paid POCs with a number of different providers. They're saying, I don't really fully understand up front the value that I'm supposed to be comping these all on. And so let's just run a POC, see how it goes. And like very often they don't select any of those providers actually, which is, as you look at ARR numbers, if they're including that experimental ARR, it's a little bit scary to see just the low percentage of how much of that could convert to ARR and that it's being included. I even heard an anecdote from a friend at a public company yesterday who was surprised they went with a specific technology that is different from one that I had brought to their team before. And ultimately the decision was, we need to have something right now. It's not the highest level of priority, but in a year, we're probably going to ultimately find a better provider. So that's even going a further step than that pilot revenue, that's experimental revenue. It's good enough for right now because we have so many things to rebuild. And this will satisfy the current need, but it's not the platform that we're ultimately going to continue to build on and be sticky to. So it just invites more curiosity, back to Yaz's point on just deeply understanding how platforms or products are being used and the value that they're delivering customers and getting those customer anecdotes on how much they appreciate and align with that product ultimately.
Yeah, I love those points. And I think like two things that you sort of evoked while you were speaking, Becca, was the first is we find that revenue coming from innovations department at large enterprises are often way lower quality than those tied to an actual business use case in a business user. Very often we have these innovations department that their sole job is tasked with like find as many AI vendors that we can experiment with so we can tell an AI story to our executive leadership team that's coming top down telling us we need to use AI tools. Those are often the ones that are first on the chopping block or the first to never even getting adopted in the first place because it's a hammer looking for a nail as opposed to the other way around. So we advise all our companies and we evaluate them. We say, go and find the business user. Don't get easily excited over contract amounts and focus more on like, can you actually drive value for a very tailored use case that you're solving? The second thing is, you can color me skeptical, but every time someone mentions a revenue number in a pitch deck, I just don't believe it. I just don't. And it's like, oh, does that revenue have an opt-out period, which we've heard of many companies in the headlines doing things like that. So it's not truly ARR, it's a pilot. Then there's, oh, it's an annualized usage number, but the usage was probably front-loaded early in the contract. I'm like, so is that actually ARR, or is that an annualized revenue metric that probably shouldn't be annualized? So like, I think we're getting to a point where we're being a little more scrutinous as to some of the earlier points we were making around not every dollar of revenue is created equally. And so there's ways to really get to the bottom of it.
And I'll just add a little bit of a spicy comment, but as investors, we're trained to view where there's smoke, there's fire. And so essentially some of these fundraising processes can get off on the wrong foot because, if you're creating an ARR number that there might be some validity to, but drives questions and we ultimately don't agree with it, we're then going to take a closer look at everything with kind of a skeptic's perspective, which, in the venture landscape where you pass on significantly more opportunities than you have to ultimately invest in, it's not setting you up for ultimate success in fundraising. So it's a little bit more challenging. And I would just encourage everyone to be incredibly upfront about, I guess, the quality of the revenue or other metrics that you're kind of flashing at investors or prospective employees, because you don't want them to, wonder what else they need to be very much digging into.
That's a super, super important point and great tip. And Becca, I've heard you mention AI story versus AI reality before. Now, what's really the difference there, and how should founders and operators be thinking about that difference?
Yeah. I think kind of going back to several of the points that we've had on this presentation or call already, founders, and enterprises alike are being pushed to create an AI story or some sort of an opportunity for them if they're not an AI native company in order to continue to be relevant. And that's not to say that if they don't, they aren't relevant, but there's so much interest in AI today that if you want to have a great chance at fundraising and acquiring customers, they might be just like looking to check that box, right? So it's not surprising at all that everyone's thinking about how do I infuse AI into my product, into delivering value, et cetera. But essentially how I drive the difference between like an AI story and AI reality is essentially, is this company and their technological architecture prepared to deliver on the AI value that they are saying is going to be coming on their roadmap? So if, essentially, not to get into it too deeply without, of revealing some names, essentially, do they have the architecture that can support the products that they're saying are going to be coming out in the next year? Is it going to require a potentially multi-year re-architecture or re-architecting of the platform, and one that, as an investor, we might say is not worth the cost ultimately for the market that they're going after? So that'd be more on the AI story side, and then the AI reality side probably is a little bit more obvious.
Mm-hmm. Mm-hmm. Appreciate you explaining that a little bit more. It's super important. I mean, the optics, the storytelling, everything around AI and ensuring that we're grounding in truth and reality is super important, like you called out. And for go-to-market leaders and founders in the audience, how should they really think about this almost bifurcated market a little bit now? Any advice for them? Yas, maybe I'll pick on you first.
Yeah.
I just on Becca.
Yeah. I think the best growth stories we're seeing for companies that are adopting AI, they fall in one of two buckets. Either AI is an accelerant for the product they're already delivering, or companies are becoming a multi-product business. And so they're selling multiple different products to the same end customer because they've launched a new AI product that is standalone as a separate SKU. And I think within our portfolio, the ones that have kind of embraced the times earlier are the ones that have succeeded the most. And it's very hard for a revenue leader that signed up a few years ago, said, I'm going to sell this product. I know what to sell. I have my targets for the year. I'm going to go, and I've built a machine around it. I've trained my sellers on how to do this. We've built a bunch of enablement. And now all of a sudden the CEO comes knocking and says, hey, you need to sell this new product, or you need to sell the product in this different way. We've seen a lot of friction in some of our companies, and often the companies that have struggled to meet the moment the most are those where the revenue leader pushes back too hard on embracing this new change. And the path of least resistance is to keep doing what you're already doing. But if we go back to what is the end goal for this business? Is the goal to continue to raise capital and to continue to grow at venture scale? If that's the case, you have to be dynamic. You have to embrace the change, and you have to continue to think about ways in which you can reinvent yourself and the organization such that you can sell these new products to different buyers within the organizations you've already sold to, so that you can get that re-acceleration of growth in the business. Otherwise, you're going to continue down a track, which for some business is totally okay. But if you want to continue to be that hyper-scaled business, just won't cut it.
Yeah, I view the question a little more from the perspective of, as revenue leaders consider their next moves, or how many phone calls from recruiters they should answer in a week, essentially. How do they ensure that they don't join one of those companies that, as Yaz said earlier, is going to get leapfrogged or has the right to win long term? I think just with that elongated path to IPO that we've seen over the last 5+ years, of the typical mark being 100 million, there are now 500 million upwards, and then the efficiency that needs to be hit at that grander scale as you grow into that available TAM. CROs or sales leaders are incredibly skeptical and nervous about making the wrong next move, just given how quickly things are evolving in the AI landscape and how much entire enterprise AI stacks are being rebuilt. So the lack of clarity in the market. And so in terms of just how we might guide a revenue leader to make the best decision there, or to just approach those conversations, I think one aspect we haven't really touched upon today, besides just understanding the right to win and the value that you're delivering to customers and understand that deeply, is just understanding the options for tangential platforms to encroach on that space. We see this very clearly with the the constant OpenAI headlines of, oh great, did this just kill XYZ company? And then there's another one, how they launched a browser yesterday. What is this going to do to the other browsers or competitors in the market? So I would encourage them to spend a lot of time understanding the companies that might otherwise have the right to better adopt, we'll say, that point solution that the company that they're evaluating joining has today, and have that be part of their larger distribution, becoming a threat to the business that they are considering.
Mm-hmm. Great point. And the common thread I'm hearing from both of you is to really just look under the hood. We can't really look at things with the same kind of surface level validity that we did in the past, and the need to actually get a little bit more granular. It's that common theme, it sounds like.
Definitely.
What about the funding landscape? We're, crazy, almost 2026. What are you both anticipating here as we head into the new year? How do you see those dynamics shifting?
Yeah, I'm happy to start. We're already seeing a lot of it. I think deal pacing is up quite a bit across the board. I think there are enough, if you think about the subset of founders that can go after and start new companies at the early stage, I think that set has grown, and that set has shifted towards being AI first in the way they're building companies. So I think we're seeing larger volumes of company creation than that 2024 chart suggested, as it was going down slightly in terms of funding amounts. At the seed and A, I think that's going to start ticking up, and I think it will continue through next year. We're seeing multi-stage firms that invest across seed through pre-IPO are starting to revert back to earlier stage investing. And so we're seeing more capital than ever happening at the seed. And when there's more capital, there's more company creation. So I do think we're now building a larger cohort of early stage companies that are going to start slowly moving down the funnel towards Becca's world. And so I think things are going to continue to be very active for investors, but it's coming from a new crop of companies that were started within this 2024 to 2025 period. And those are now starting to graduate at faster clips because there's more companies in those cohorts. Most of them are AI native, and a lot of them are seeing time between rounds go down to all-time lows. And so that's my prediction of where things are going. Beck, I'm very curious because you're at the other side of the mountain than we are.
Yeah, totally. I think something's going to have to change in the future, and I don't know if that's going to be more of a permanent change or short-lived. And what I mean is that there's so much talk about whether or not we're in a bubble today. We're seeing 100 million ARR multiples, just like 2021, which we've all more recently lived through that shift from the usurp area to post that. And then we're seeing companies raise multiple times in a year and sometimes even in subsequent weeks, which is just completely insane. And so I think what I have to be very careful to not try to call out is when does the bubble burst, because truly no one knows. And as Yaz is saying, there's tons of capital in the market. A lot of more traditional multi-stage funds are going earlier. So I think something's going to have to change in terms of the multiples, in terms of it making sense as companies grow towards the public markets to not have the more recent private market financings be underwater, essentially. I just don't know when we're going to be seeing that shift. And every day when news comes out that we think is going to affect the market in one way, and then the tech stocks are just performing super strongly, it gives me more pause to think that that's the bubble is going to burst very soon. But I do think just what we're seeing in terms of the momentum of fundraising is pretty hard to grasp and pretty insane.
Truly. Agreed. We've never really seen anything quite like it, at least in our lifespan. Seed valuations are pushing an all-time high. At the same time, what we're also seeing is Series A is harder than ever. So there's a lot of early stage funding, like Yaz called out, but to actually get to your phase, Becca, we're finding that graduation rate to be a little bit more challenging for companies for all the reasons that we've talked about. Like, it really is a flight to quality now. Fewer deals get done at the later stage, and they're commanding premium terms. So, if you're building something real, the capital is there, but oftentimes it's not enough to simply have some of the metrics that you had in the past. It really has to align with all the different kind of theses that investors are looking at, the space, the timing, the valuations, everything.
Yeah. And so, Sophie, I think one thing I would call out is I actually think the flight to quality happened in this previous, call it, if we do things on a look back period. If I look at a look forward period, I actually do think deal volumes and deal dollars are going to be quite a bit higher than 24 was, and I think it's going to trend to near 2021 levels, if not higher. I think the biggest difference is just that in 2021 we saw this level of activity and this level of exuberance. I remember how crazy it was. We were investing through that period, and I was like, there's going to be a graveyard of companies, and that largely played out. I think the difference here is that you actually have companies that are growing into these valuations. And so because of that, I actually think the exuberance and the frothiness will be higher than the 2021 period in the next year or 2 years to come, because people are so afraid of missing out on the generational companies that are being crowned today. And we're seeing that in the way that funding rounds are coming together. Becca, you mentioned the rounds happening in a few weeks after their previous round. It's happening in pockets. It's happening in pockets, right? So there's the ERP market. All of a sudden, one company raises a few weeks after their previous round, and then 3 companies raise in rapid succession at exorbitant multiples that they're going to have to grow into. And so you're seeing people afraid of saying, oh, if there is a winner in a market, I need to have a play there. And so you're seeing so much capital flowing towards these pockets. And I think it's because people are seeing some of these big early success stories, and they want to jump on as early as they can. And it's just going to continue to drive things up over time. And when will the music end? God, that's the $1 trillion question that I don't think any of us can answer.
I was going to say $1 million question, but you're right. It truly is a $1 trillion question. And as we get towards time, for founders, what would you say one final takeaway is for them to be able to have a piece of advice around how to successfully fundraise in this market? If you could leave them with one takeaway.
I'm happy to start. And I would just say, align your interests with your investor more than anything. Who you pick is going to dictate what success looks like. And what success looks like will vary from person to person. And so if you are raising an early seed stage round because you can at a crazy high price from a crazy multi-stage company, from a multi-stage firm rather, very early on, the expectations for your growth are just exorbitant. And you will not make money personally unless you meet some of those massive growth growth thresholds that are set for you in the future. And so think about your fundraising strategy as a way to dictate the way in which you want to build your company. There's no right or wrong way, but really make sure that what success looks like to you is aligned with what success looks like for your investor. Otherwise, that tension will kill the business and will kill the excitement that you have in building a company that wants to solve the problem that you're really seeking out.
Yeah, I couldn't agree more, Yaz, and just really understand that the investors you're going to partner with believe in what you are building and believe that you have an advantage in building that platform, I think is incredibly important. And essentially, as we all know it, typically an investment time horizon is like about 10 years from that investment to an exit. And so taking the time to deeply understand the individual at the investment firm that you're working with to understand if you want to be on that long-term journey with them, I think is incredibly important.
Echoing both of you, couldn't agree more. Those are, I would say, different versions of the same thing. And I would echo the same thing around your partners around the cap table are pivotal to your success in the long run. Like Yaz called out, it's not 1-2 years. It's about a decade or so of relationships. So making sure that there's the right people, the right individuals, the right firms, the right strategic value around it. And thinking in terms of if capital was commoditized for you, how would you round out your cap table? Like who are the right people who are going to be the strategic levers for customer introductions, for anything on the tech side, for your go-to-market, all these different factors around that, and trying to create almost a cohesive fabric around all those different pieces that, based on your individual strength, based on your space, are going to help round you out. Becca, Yaz, this has been fantastic. Incredible advice and just insight overall to the fundraising landscape right now and also into 2026. It makes me very excited for 2026 too. Now, we've got a couple minutes for questions. I know we've got a couple in the chat here. If anybody does have any questions, please feel free to pop them in there. Let me see and grab a couple of these here. Awesome. Thank you, Patrick, for all the words in there. I know somebody had a great question just around timeline for AI companies. Becca, Yaz, are either of you seeing different expedited timelines in terms of that liquidity event for AI companies? And I know we're very early to that, but in terms of, the markups, the signals that are on our way to getting there, is that quite different what you're seeing?
I think it's hard to generalize across all companies. What I will say is that I actually become a little bit more skeptical when I see companies have a condensed timeline to IPO. They might have the ARR metrics and growth rates today to get to that standard, let's say $500 million plus TAM or not TAM, but revenue line to go public. But essentially, if that's where they are running to and then heading for a quick exit, what I ultimately am cautious about is that they don't see that the TAM opportunity from there is much larger, or they don't think that their tech is so defensible that they're not going to get leapfrogged or encroached on thereafter. And so while there are opportunities to go public or to exit sooner, and being a growth stage investor, I just say go public more often because that's what we typically invest in. Our platforms have that capability. I do like the opportunity for companies that can grow more in the private markets. I've been a Databricks investor for many years, and there's always been the question of, will they be more capital efficient, burn less? Those are slightly different things. So focusing more on like the reduction in burn. And essentially what they have said over the years has been the opportunity ahead of us is so large. If we can efficiently continue to grow into it, that's our choice to be moving that way. And I couldn't agree more that that's been the right opportunity for them. And I'm interested in finding more platforms that have that large market opportunity ahead of them.
Great point. Appreciate that. And if any follow-up questions to that point, feel free to pop them in the chat. We've got a couple other questions. We'll do our best to cover them here. First question from Parth. Great question, Parth. How are we thinking about AI service companies, companies that leverage AI in their service delivery as opposed to a pure play SaaS model?
Yeah, AI-enabled services is actually a very large thematic area for us as a firm at Emergence. We've invested in a number of these companies. I think the key insight here is to avoid what's called mirage product market fit, which is revenue can grow very quickly before you actually have true product market fit. Because in order to actually be AI enabled, you have to make sure that the platform that you're building internally actually yields some benefit in your ability to deliver that better than just another dev shop or some, BPO or what have you. And so you no longer look to revenue as the guiding North Star to show whether or not it's working. Your ability to go from one deployment to the next has to become far more efficient, such that you can get to the high gross margin scale that you could exit with strong multiples on. And so I think that the TLDR here is like AI-enabled services, I think, are actually a very exciting category, so long as you invest very heavily in the platform that allows you to deliver that service scalably with high margins over time, which is aligned with driving the business outcomes for the end user, and revenue isn't the North Star metric.
Excellent explanation. And I think we've got time for one more quick question. We've got Morgan. Are you seeing hold periods being adjusted in or out based on how the new dynamics are operating in this AI native market?
I guess, is that more like a fund construction question?
Yeah, I think, Morgan, feel free to pop any. Yeah, he says yes.
I think hold periods for growth stage investors have always been more of a moving target and best guess, just given there's a lot of movements that the larger market could be making that change the capabilities for a company to exit or to go public. And so I don't put too much stock in those expectations. It's more around, how you can communicate those to LPs, but having them understand too that they're not, definitive answers that we can be giving anyone.
Yeah, I would very much so echo the same. Awesome. Well, Becca, Yaz, this has been fantastic. Really appreciate you sharing all of your insight perspectives. For anyone in the audience who wants to follow along, Becca and Yaz's LinkedIns can be found in the chat. Appreciate the time, and thank you everyone for tuning in.
Thank you.
Thanks, everyone.
Back, everybody. That was an amazing session. Hopefully you guys are still on. My name is Mike Coverly, again, head of community here at RevGenius and also the founder of Bottle Rocket Growth. This section, our next session, is finding your best fit buyers. Build a territory strategy that generates revenue, led by someone who spent her career helping sales teams focus where it matters most. Leslie Vanetz, founder of the sales-led GTM agency. Leslie's going to walk you through how to align your territories, target the right accounts, and drive real revenue instead of just activity. I'll be dropping. Thanks and enjoy the session. Leslie.
Yes, I'm here and I'm so delighted to be here. This is great. I'm like, one of the most hilarious things I'm noticing with the deck that I'm going to share, when it got converted, a bunch of the letters dropped to the side. So y'all will have to forgive me for these small editing errors because the content is going to be fire that we're going to go through today. I think Mike dropped my LinkedIn